Hello again from Monaco. Last week, by kind invitation from Professor of Finance Dr. Damir Tokic, I gave a lecture on trend following at the University of Texas, Rio Grande Valley. I was very honored because this could be as close as trend following gets to academia. As it has now become customary, I delivered the lecture via Zoom, which makes for a somewhat awkward format, but the content would have been the same even if I had delivered it in person. I've posted the entirety of the lecture here, including the Q&A session that popped a few very good questions, particularly one that's central to the problem of risk management. The lecture itself seeks to condense the key perspectives of my 25 years experience in financial and commodities markets, in trading and risk management. I hope you'll find it illuminating.
All right, guys. So what I'm going to be talking about is market trends and investment performance. I'll start just to introduce myself so you know who I am. So I began my career in 1996 in oil trading. Over the last 20 years, I've traded extensively stocks, bonds, foreign currencies, and commodities. I spent 15 years as a professional investment manager in hedge funds. I generated a continuous track record from 2007 to 2019, consistently outperforming my strategy benchmark, including the world's leading managed futures funds. During 2008 bear market, when most investors sustained heavy losses, I was among the small number of managers who generated positive 27% return to my investors net of fees. In 2020, I founded Craner Analytics to provide investment solutions and decision support for investors, traders, and hedgers. I published two books related to trading and investing, Mastering Uncertainty in Commodities Trading, published in 2015. And this year I published Alex Craner's Trend Following Bible. All right, so about today's presentation, we're going to look at the monetary system, inflation and the need to generate investment returns, uncertainty as the main problem that we're dealing with when we're trading and investing, market trends and momentum investing. We're going to look at trend following. We're going to compare decision-making by trends versus fundamentals. And we're going to finish up with a few do's and don'ts of trend following. Monetary system. So something happened in the 20th century, and this chart is from Jim Reed's 2012 report titled Journey into the Unknown. And what it shows you is that over the past 700 years, inflation hasn't been so much of a problem as it has been in the 20th century. In the 20th century, inflation became endemic to the global economies, and virtually all of the world economies now are living with a sustained chronic inflation that we now take as part of our normal, but it hasn't been normal up until the 20th century, and particularly since the formation of the Federal Reserve Bank in 1913. So on the left, you have the median inflation series since 1209, and on the right you have it over the 20th century and into the 21st century. So as you can see, there has been a phase change and the situation is very different. Now, what it means for us is that the purchasing power of your money is continuously being eroded, which everybody understands, even if they don't think about it intuitively. You know that your money buys less and less every year, and this is what it looks like over the long term. Since the formation of the Federal Reserve Bank, the purchasing power of the US dollar declined something like 97, 98% to today, and it is continuing to decline. So that means that the value of your saving is being continuously eroded. You cannot just keep your money under the mattress or in the bank. So what you have to do is you have to invest it to try to generate an investment return and offset the loss that you have with inflation. So the biggest problem that we're dealing with when we are investing our money is uncertainty, which is the most difficult problem facing all traders, investors, and hedgers. Simply, uncertainty entails that we have no way of knowing what might happen tomorrow, let alone 5 or 10 years from now. As investors, we can only make our decisions in the present, but the results of those decisions will depend on future outcomes, which we don't know what they will be. success in investing will depend on the quality of decisions we take and execute over time. Okay, so basically we have two conventional approaches of dealing with uncertainty. First, we have quantitative methods and we have forecasting. So we'll deal with each one in turn, and I'll try to explain their risks and limitations. So with quantitative method, we're trying to identify. I'm sorry. Was there a question?
No, I think they continue.
Okay, sorry, I thought I heard somebody. Okay, so basically with quantitative methods, we're trying to identify predictive attributes in market data, and then to build trading algorithms to profit from these predictive attributes. However, there are significant risks inherent in quantitative trading, which usually are tagged under the label model risk. So there are two kinds of challenge that contribute to model risk: conceptual issues and software coding errors. Conceptual problems stem from misunderstanding of data and the relationships between the observed patterns. So typically what happens is the correlation is mistaken for causation. And I'll give you an example. Let's say we identify that an event B follows some observed pattern A 75% of the time. This does not mean that A causes B, or that there's a 75% probability that that B will happen the next time we detect the pattern A. That doesn't sound like a sensible sentence, but I'll illustrate. So let's suppose we toss a coin 1,000 times and we mark results, H for heads, T for tails, and that would give us something of a string looking like this, right? TTTHH, that's all. And now suppose that in this string of 1,000 characters, we identify the pattern TTTHH 100 times. And then further suppose that in those we find that in those 100 patterns, pattern TTTHH is followed by the letter T 75% of the time. Okay, it would be correct to say that in our data sample, a T follows the pattern TTTHH 75% of the time. It would be wrong, however, to say that there's a 75% probability that a T will follow TTTHH. And this is because with coin tosses, the probability of either result is always 50%, regardless of the pattern or correlations in our data. This is very intuitive and easy to understand with regard to coin tosses. But when we're dealing with market data, the data can be very complex, and it can be much more difficult to interpret correctly what we're looking at. So knowing what events cause what other events can be very, very complicated, and we can make mistaken assumptions. So the result can be conceptual errors, which means that quantitative models will often be based on mistaken interpretations of data and flawed hypotheses. The second set of problems with quantitative analysis is software coding. Even if quants formulate a correct hypothesis, they face the next important challenge, which is related to software coding. Namely, quantitative models are almost always based on software code. Writing software code is always very error prone. And we know that professional programmers make between 100 and 150 errors per 1,000 lines of code. And this is an empirical fact from a very large study by, I forget now. I can provide you the source for that, because this is an important study. There's a very high tendency for professional software programmers to have error in their code. And a thing to appreciate is that your quants are usually not professional software programmers. They're usually mathematicians, physicists, and so forth, who have some training in software programming, but they're not professional programmers. So this statistic that they make 100 to 150 errors per 1,000 line of code could be worse for mathematicians and physicists, let's say. So these coding errors can often be very difficult to detect because you don't see something blow up with financial applications. You just find out over time that it's not performing quite the way you'd like, but you may not know why exactly. All right, so if you follow financial media, every so often you're going to encounter a story about poor and sometimes disastrous results of quantitative investing. There is, however, beyond the, let's say, anecdotal evidence, there is some empirical evidence showing how difficult it is to achieve success with quantitative methods. So I'll give you two examples. First, in 2006, world's most popular trading platform, MetaQuotes, began to organize automated trading competitions. So they offered $100,000 prize for the winning algorithms. Over the next 6 years, they attracted 2,726 participants. And of these 2,726 participants, only 21% traded profitably, 79% lost money. And so we're talking about a relatively sophisticated group of people who were, in some cases, teams who were capable of writing software codes, who understood data, and who were highly motivated to win in these competitions. Nevertheless, 79% of them lost money. The other bit of empirical data is that in about a year ago, we saw a first comprehensive review of robo-advisory performance, which found that more than 85% of all portfolios traded by robo-advisors underperformed. So we're talking about professional money management, not just the individual traders. So the company called Backend Benchmarking tracked the performance of 60 robo portfolios, compared it to a 60/40 ETF portfolio as a benchmark, and deducted 30 basis points for expenses charged by advisory platforms. What they found that over 4 years, over a 4-year period, only 14.3% of robo portfolios actually outperformed the benchmark. They found that robos outperformed their benchmarks in every period, so 12-month period sequentially. And the average underperformance was approximately 1% for each period. Here we're talking about real portfolios, about real companies providing robo-advisory services. So this is quite a significant finding. We're going to move on to forecasting as the other conventional approach to dealing with uncertainty. So among professional investors, large majority rely on forecasting for their trading decision. Vast resources are dedicated to analyzing markets and trying to predict future developments. This approach is unreliable, as well as we'll illustrate with a few examples here. In January 2019, the Wall Street Journal asked a group of experts to predict the interest rates on US 10-year Treasury notes for mid-year and year-end 2019. This was the result. So the forecasts ranged from 2.5% to 4.3%. While in reality, the interest yield dropped below 1.5% and never came even close to any of those analyst forecasts. The second example concerns the oil market, which is again important because it's the largest and most closely studied commodity market in the world. Every year, the U.S. Energy Information Administration publishes an exhaustive report titled International Energy Outlook, which provides long-term forecasts produced by EIA itself, as well as a number of world's leading research institutions. So after many years of wide misses, because this has been a problem, the EIA began to project future price forecasts as a broad range of low and high prices. What you see here is their 2014 forecast based on the industry's best information from world's most highly reputed institutions. The blue line is the actual price of Brent crude oil between 2000 and 2020, while the gray lines indicate EIA's reference forecast, high forecast, and low forecast. And what you can see here is that this forecast has been badly wrong practically since the day it was published. It's been mostly wrong for the past 7 years, and the oil price has only come close to the range, to the low forecast level, just now in the recent months. Basically, today, in spite of the fact that their high-low range spans more than $80 per barrel, even with this very, very broad brush, they failed to correctly forecast oil prices. Last example, stock prices. So twice a year since 1946, U.S. Federal Reserve Bank of Philadelphia publishes the Livingston Survey, which summarizes various economic forecasts by 31 prominent economists from government, industry, and the leading financial and academic institutions. On this chart, you see their forecast published in June 2007 and June 2008. The red dots and the blue dots show their 6-month, 12-month, and 18-month forecasts. And these perpendicular dashed lines coincide with the survey publication dates. Again, as you can see, all these leading experts never even came close to correctly forecasting. Basically, what they're forecasting is that the stock markets would rise in a straight line, whereas what actually happened was dramatically different. So this was the last financial crisis that we experienced in 2008 and 2009. Okay, so I could probably show you many, many more examples of this, but the reason why I picked these 3 examples is because they concern some of the most important and most closely analyzed markets in the world and forecasts generated by the world's leading, most highly reputed research institutions. And their track record is basically embarrassing. The reason why forecasting fails are several, but the main difficulties arise from the following problems. First, the forecasters always deal with incomplete, biased, and untimely information. Sometimes it's flat out wrong and how do you call it? Well, I guess I have to say fraudulent. I can't think of a better word, but sometimes the information is deliberately massaged and biased. Second, the problem has to deal with complexity of markets. Namely, there are very many moving parts, and making sense of it and then projecting market prices into the future really is extremely difficult. Finally, less well understood, less discussed problem, but a really grave problem is the existence and prevalence of groupthink among market experts. And I'll give you an example again, just so you get a grasp of what I'm trying to say. We already talked about the EIA and their 2014 oil price forecast. This one is from 2003. So basically, in 2003, the EIA projected 2 years forecast into the future, and what you see here on the right, their forecast for 2005. And these are all the institutions that submitted their forecast to the EIA, as well as the EIA itself. And as you can see, the forecasts were all clustered in the zone between $19 and $23 per barrel. So 2 years out, they basically saw oil trading exactly where it was at the time when they published the forecast. Whereas in reality, oil price rose by a factor of, I think, 150%, right? There's a reason for this, okay? It's not that the people are necessarily stupid, but when these institutions publish their forecasts, they basically stake their reputations on the forecast. So if they are way wrong, that can damage their reputation. So even if in one of these institutions there was like a really smart analyst who thought, okay, no, price is gonna more than double over the next 2 years, so we should just basically publish that forecast. If that turned out to be wrong, they could make themselves a laughingstock. It could even jeopardize their business. So from the institution's point of view, it is always safer to be wrong along with everybody else than to get it right, but risk getting it very badly wrong. So what you get as a result is kind of institutional groupthink, where even if they knew better, they might not be willing to stick out and say so. But this is a real problem. When you read, I don't know, market forecast by some very, very highly reputed institution, there's all kinds of decisions that go into that forecast. So you might not be getting their best expertise, even if it's there. All right, so moving on, this problem is related to the question of market narratives. Namely, this whole expert class basically makes a living off of having always something to say about markets, even if they have to pull on straws. Narratives create the illusion of expertise, the idea that we understand market events and that experts always have explanations for the way market events, news events influence markets. Here I have an example for you. This is 2 headlines published on the very same day, several hours apart, by Reuters. First one says, European stocks rally after ECB unveils more stimulus. And then prices went south after they rallied, and then they published the article titled European Stocks Turn Lower as ECB Says More Rate Cuts Are Unlikely. The next example, I had these headlines exactly on my Bloomberg screen one day. This was in 2014, I think, 2013, I don't remember. But you have three titles related to yen. And they all say, you see, yen rebounds as Turkish lira rally, yen decline as Turkish action cuts heaven demand, yen advances. All these articles were published hours from one another. Again, it gives you the impression that some expert there is explaining to you what's happening and why, but basically they're just like giving you some kind of a narrative for you to read and think that that's something, but they don't really know. So the illusion is that the cause and effect relationships in markets are all clearly understood and explains, which creates the impression that news events move markets. And this is a fairly significant point. There's a really strong consensus among market participants to believe that news events move markets. This is only partly true. News events do move markets, but their impact is relatively limited, and it usually is the impact is very short-lived. So I created a little illustration to show the point. So this is the daily price chart of the US 30-year Treasury bond. I removed dates, I removed the levels because they're not important. What I just wanted to show is that on this chart, we had some news events. We have US inflation index rises to 58-month high, and the price goes up a little bit. It should have gone down, but it went up anyway. Here we have the government tax revenues fall most since the last recession. The index goes down as it should have. I mean, sorry, not the index, the 30-year Treasury note. So interest rates goes up, 30-year Treasury note price goes down. Then we have jobs report shows economic growth. The note goes up appropriately. Then something about Brexit negotiations in Brussels and so forth. All of these events happened in the area that is here in this red circle. So you can see, and here you have the 20-year chart of the US 30-year Treasury bond. So what you see here is the impact of those news events and how limited it is, whereas the large-scale price event is something that had a continuity for practically 20 years, not in a straight line, but in a zigzag fashion. But the large-scale price event unfolded as a major market trend. News event, on the other hand, had very, very limited impact that happened on the day of the news. And then basically, if you look at this 20-year chart, you can imagine that every single day there was some news event that were interpreted as moving the markets, but the real price events unfold over long periods of time as trends. So that brings us to the hypothesis that market move in trends, which is outside of academia, is not that controversial. In academia, for some reason, in some places, it still is. But regardless, it's enough to look at some charts. And I like to use this quote as well, because it's 2,000 years old. What it says is by Sun Tzu in The Art of War. He says that trends are one of the three great avenues of opportunity. And what this tells you is that trends are something that has been observed for as long as we have had civilized life. Let's look at some examples of trends. So this is price of gold in the 1970s. I like to show this one because this happened through an inflationary period, and there's a risk that we will enter another inflationary period. Basically, what happened is that during the 1970s, the price of gold went up 24 times. Before 1971, gold was fixed at $35 per ounce for 30 years. As inflation started to increase, the gold prices moved from 35 to 850, which was peak in January 1980. Then here you have a 50-year chart of NASDAQ, which has included some major corrections and bear markets in between. But basically what you have here is a 100-fold increase over a 50-year period, most of which is showing a long uptrend. Trends go down as well. So here you have prices of coffee. There's a 3-year downtrend looking almost as a straight line. Equally, exchange rate of US dollar and euro between 1995 and 2004. New York taxi medallions. You see, you have a 20-year chart here. And the reason why I showed this chart is because it shows that trends occur even in all kinds of different markets, which includes arts and collectibles and wines and so forth. And here you see New York taxi medallions, which the prices have advanced in a trend for nearly 20 years. Then you had a large reversal here in just before 2015, and then you had a sharp downtrend, which also lasted about 5 years. The next chart is Bitcoin. You've heard of that one. Then there's Tesla, and this is a very significant one for what we're going to talk next. Tesla has increased by a factor of 10 times between 2012 and 2014. Then it kind of drifted higher over the next few years. And then again, up to 2020, it rallied another 12 times, actually a little bit more after that. Near the end of 2020, Tesla's market cap surpassed that of the next 7 large car manufacturers combined. Over the last 10 years, the S&P 500 index increased by over 300%, but the car manufacturers have not been a great investment. Now, here's what the other car manufacturers looked like over that same exact time period. So if, let's say in 2011, you invested $1 in the share price of Toyota, 10 years later, you had about $2. If you were unlucky to invest in Ford, you had half a dollar. And with all the other ones, more or less, you broke even. And this is how that compares to Tesla, right? And this is on a logarithmic scale because on a linear scale, the other car makers look like a horizontal bumpy line. So, how to explain that? Basically, the stock price of Tesla, there has been narratives woven about this. The expert class always has something to say about this, but basically it's very hard to justify Tesla's stock price on any rational valuation basis. But the undeniable reality is that Tesla had massively outperformed its peers, and that was a trend that's held for a whole decade. This is not actually an anomaly, but only a recent, if spectacular, case of the recurring theme that markets move in trends. Trends often eclipsed all our notions about asset valuation, both on the upside and often on the downside as well. So basically, if you had the wisdom to buy some shares of Tesla in 2011 and hold it for 10 years, you would have made your money 120 times over. But unfortunately, not many of us have had such foresight. And that also speaks to the idea about stock picks, because most investors are obsessed with stock picks. Give me a stock pick, which stock is going to do great. And then, like they make 50, 100% and they'd say sell out. Probably the only people who made their money 120 times on Tesla shares are people who didn't trade it, people who sat on it and forgot about it. And so I'll go back to the question of trend following. Basically, the question is, what if you systematically pick the winners? What if you always just pick the best performing stocks? Suppose you systematically bought top performing stocks regardless of what you thought about the companies in question, about their stock price, about their products, or about their management teams. You'll be onto something extremely powerful in that case, and this is what we call the momentum strategy. The momentum strategy is basically a variant of trend following. It entails systematic investing in best performing stocks, holding them for as long as they outperform. And then we'll look at how well that strategy performs, because we have very good empirical data for this. London Business School researchers Elroy Dimson, Paul Marsh, and Mike Staunton reviewed nearly 110 years of UK stock market data between 1900 and 2009. They simulated portfolios of top 20 of the largest 100 companies over the previous 12 months versus bottom 20 and the middle 60. Recalculating the allocations once per month. Basically, what they found out is that the lowest performing stocks would have turned £1 invested in 1900 into £49 by 2009. The top performers would have turned £1 into £2.3 million. That's a 10.3% difference in compound annual returns. So that's extremely powerful. And basically, what you have here is people always investing in things like Tesla and holding them for as long as they outperform systematically. And this is the difference that it generates over long periods of time. So Tesla is a spectacular case of exactly this. So basically, enlarging their analysis, the same researchers then analyzed this for all of London stocks between 1955 and 2009. Top quintile generated 18.3% return on investment, bottom quintile 6.8%. Again, a huge gap. Then they replicated the study on 18 global stock markets. The results were striking and remarkably persistent in all but one of them, and that one was Japan, because it was based on the post-2000 data. And keep this one in mind because I'll revisit the Japanese experience over this period. It's kind of significant as well to what we're talking about. The significance of the Dimson, Marsh, and Staunton study is that it provides us very compelling evidence that trends are the most potent drivers of investment performance over the long term. So that brings us to the strategy of trend following. And forgive me, I'm rushing a little bit because I think that I'd like to leave more time for Q&A, which might be more interesting afterwards. You can have the copy of this presentation and you can review it yourself as well. So basically, trend following relies on a field of research called technical analysis. It concerns itself with the study of price charts. Technical analysis does not attempt to explain the mystery of markets, nor does it pretend to be a rigorous science. Basically, it's merely a repository of decades of observations and experience by thousands of markets practitioners. Technical analysis primarily relies on judgment and some simple geometry and math within the framework of three core beliefs. And these three core beliefs are: first, the price discounts everything. Second, history repeats itself. Third, market moves in trends. And I'll now explain what each one of these beliefs entails. The belief that price discounts everything is the assumption that all information that is known and relevant to the value of some security is already reflected in its price. That's not too terribly controversial because it's essentially the same belief that's held by efficient market hypothesis. The second belief is that history repeats itself. This one is a bit more controversial, but basically technical analysts believe that chart patterns which were repeatedly observed in the past will likely continue to appear in the future with similar implications for investors. I have to say that when I started studying technical analysis, I thought it was absolute hogwash. I read John Murphy's book on technical analysis, and I was almost fresh out of college. I just could not believe that anybody would even take that stuff seriously. However, having spent several months doing technical analysis, I found that this belief actually is well-founded. The third one is that markets move in trends. Basically, when prices start moving in one direction, the belief is that they are more likely to continue in that direction for some time than they are to reverse. Having said that, there's a broad observation among trend followers and technical analysts that markets tend to trend about 1/3 of the time and consolidate or correct about 2/3 of the time. And that's going to be relevant to another point I'm going to make a little bit later. All right, so we're going to make a little comparison between trend following and forecasting, okay? That is, when I say forecasting, what I mean is the conventional market analysis based on market fundamentals and then trying to forecast what's going to happen in the future. So you all remember this forecast, which I mentioned before. So it's a Wall Street Journal survey of market experts to predict the yield on 10-year Treasury notes 6 months and 12 months out in 2019. We see here expert forecasts versus what really happened. Now, just one thing to make clear, everybody understands, this is the yield. So when the yield goes down, the price goes up, right? That's a corresponding move. This is the performance of the trend following model that I've developed and I use. Basically, what you see here in the top chart is the price of the US 10-year Treasury note here. In the bottom, you have the performance of 22 individual strategies, which are all trend following strategies. And in the middle, you have the exposure chart, which is fluctuating between 100% short, if we believe the market is in a downtrend, and 100% long, if we believe that the market is in an uptrend. So basically what you can see here is that we had between 2018 and 19, we had a downtrend. Then we had a broad reversal at the end of 2019. The trend following strategies, not knowing what was going to happen, basically gradually reversed from net short to net long. And then the trend went up, meaning interest yield going down, prices going up, without knowing, without trying to forecast, without trying to analyze. Trend following strategies basically traded on the long side, and as a result generated very significant profits in 2019. Something similar happened over the summer, but in a much shorter episode in July 2021. Basically, you had yields go up again, which, because of the inflationary worries, took the market by surprise. Many funds took extremely large losses. One fund lost something like $2 billion, one major hedge fund, because basically everybody expected that, given that we have an inflationary environment, that yields should go higher, but instead they went lower. And I'm not going to go into the details, but I did post an analysis of that episode in a YouTube video that I posted on my YouTube channel. And this is just the thumbnail of that video. Next example, I published a chart analysis of Bitcoin. Basically, what happened is that we had, this is the price of Bitcoin through 2020. At this point, where you see the yellow star, I published an analysis saying that Bitcoin was due for a major correction. At the time, Bitcoin fans didn't believe it. Some of them came back to me and said, "You're full of it. Chart analysis is worthless. Technical analysis is not worth anything. It's the same as reading chicken entrails and tarot cards." But actually what happened over the next few days is that Bitcoin declined 36% below the price, below this neckline. This is technical analysis. What you have here is a head and shoulders pattern. When the head and shoulder pattern breaks the neckline, the implication is that the price goes into a correction. What happened in the aftermath? 775,000 traders of Bitcoin had their accounts liquidated, equal to 8.6 billion worth of crypto. All right, moving on, oil price. So this is what happened last year in 2020. Oil price declined by almost 80%. And there were some reports that for the first time ever, there were actually negative oil prices being recorded. I'm very skeptical, but everybody in the news reported that. So anyway, this is what happened. I'm not aware of one fundamentals analyst who actually correctly predicted that oil prices would happen. Again, you had consequences which were severe. ABN AMRO Bank lost $1.2 billion. Singapore's billionaire oil trader filed for bankruptcy. They lost $4.2 billion. Ryanair, a European budget airline, lost $325 million from oil hedging operations. This is what happened. Basically, again, you had a survey of market experts in January 2019 who were polled by Reuters and predicted that crude oil price would stay in 65 and $75 per barrel range through 2023. So that's this red line. There was another survey at the beginning of 2020, essentially unchanged. So basically, these experts always see the prices exactly where they are. So if the price is now $75 and you ask them to forecast price 4 years out, they're going to say, oh, it's going to be $78 or it's going to be $72. What happened is an 80% decline over the period of 4 months between January and April. Here you see again the performance of a set of systematic trend following strategies. Again, no idea what's going on in the market, no analysis of fundamentals, the demand, supply, geopolitics, whatever, just simply reacting to what's going on in the market and sailing along with the trends. So what happened here is that these strategies generated a net profit of about $42 per barrel through this market crash. And then again, as in 2020, 2021, as another trend unfolded, again, by simply going along with the trend, strategies performed again. Here we have a longer term performance chart of these same or similar strategies since 2014. And over this period, they generated a profit of about $96 per barrel through May 2020. Showing you this chart, I want to point out another thing: that trend following is not a simple gimmick of just making money for free every day, because what you'll notice here is that in the price chart, you'll have some very significant price move that unfold as trends. And coinciding with those price moves, you have very strong profits with trend following. However, you also have very, very long periods of time when the strategies are either performing flat or they're actually losing money. And so this is a fact of life for trend following. Part of the game is exercising a great deal of discipline and patience through periods of consolidation and reversals, and then picking up profits when trends actually do unfold. Basically, for this reason, I like to compare trend following with fishing. So basically, if you imagine that you have a small fishing boat and you specialize in catching tuna, you know that in certain seasons, large schools of fish may pass in nearby waters, and during those seasons, you can land a large catch. The problem is uncertainty. Again, you don't know exactly where or when you're going to encounter this fish, but to catch them, you have to set out to sea every day and cast your lines, which cost you some time and effort and expense. Your reward is that from time to time, you're going to land a large catch, which is going to make up for what you lost on unsuccessful attempts. Parallels with trend following are the exact same stuff. You have uncertainty. You know that market trends will appear. You don't know when or in which markets. To profit from these trends, you have to continually position your trades in the direction of the anticipated trend. And then from time to time, as the trends unfold, they bring you profits that make up for the losses you incurred while attempting to catch a trend. Again, going back, this is a zoom in to our performance over 2019, 2020. This is the period where in 2020, when oil prices collapsed, trend following strategies caught this move, but the price of that was more than 8 months of basically waiting, losing money, and positioning long, short, cutting losses, taking profits a little bit until the real trend unfolded. This example is the same, only with the copper between 2020 and 2021. 2019, 2020. Basically, again, you see very strong positive performance, but all of it happened with this trend in 2019 and 2020. During 2019, we basically incurred losses. And at the beginning of 2020, it even looked very ugly. So you had to believe in what you were doing to be able to take this profit when the trends emerged. All right, so we're going to look at a few advantages of trend following. Basically, you have direction and timing of trading decided because you're not trying to predict what the markets do. You're just simply reacting to market events as they occur. If you do it well, the trend following should improve your investment performance. Investing scope, basically, if you focus on analyzing price charts, then you can trade any market you like. You can trade gold or Bitcoin or foreign currencies, stocks, bonds, whichever, because you're not trying to understand the fundamentals of the oil market, of the cotton market, of the stock market. you're simply analyzing the price chart, and all the price chart are fair game for trend following. The next question we have to ask ourselves again: why take risks at all? Basically, again, the metaphor with fishing is valid. For the fisherman, his efforts are justified by his belief that schools of fish will periodically pass within the reach of his nets. For the trend follower, the belief is that market moves in trends, and that with good judgment, well-formulated strategies and discipline, he'll be able to profit from them. Willingness to take risk is motivated by the necessities of life. For fishing is necessary as a source of sustenance for the fisherman's family and his customers. Investing is predicated on our needs to generate return on our capital. If money lays idle, it predictably loses purchasing power over time, as we already discussed. Basically, one of the best formulations that I come across about why we have to take risk was formulated by St. Thomas Aquinas, who said that if the highest aim of the captain was to preserve his ship, he would keep it in port forever. Obviously, we don't build ships to preserve them, but to use them, to put them to productive use in profitable enterprise. Then there's the question of value investing, which unfortunately we don't have time to follow now. Investors always ask, why isn't value investing the best approach to generating long-term returns? The answer is no. And basically, I've put together a short video. I think it's about 15 minutes long, which analyzes the performance of the icons of value investing like Benjamin Graham and Warren Buffett. And what you find out when you look closely at the way they invest is that they are trend followers and momentum investors, not value pickers. That is, if you strip out their momentum plays from their value picking, they underperform. And all of their outperformance is entirely due to their momentum picks. All right, so that's in this video, which this is a thumbnail from the video. You may find it on my YouTube channel, which is Markets, Trends, and Profits. And here below, I put the link to the channel, and the videos are there. All right, moving on. We'll go quickly over a number of do's and don'ts of trend following. Mostly it's common sense stuff, but it is important. Number one, study technical analysis. It's worth your while because as you do that, your judgment will improve with time as you look at hundreds and thousands of charts. Use daily price charts. As you can find trends in intraday charts, things that 5-minute charts, 60-minute charts, but these will all be relatively small moves. Large-scale price events unfold over weeks, months, and years. So you will pick them out by using daily price charts. Do not day trade. Up to 95% of active day traders actually lose money. Set the right objectives. We all would like to double our money every year, but this is not realistic. Long-term stock markets have compounded at around 10%, and the best professional investors, best hedge fund managers, achieve between 10 and 15% returns over the long term. This is after fees, so let's call it 10 to 20% before fees. So let's say that you can legitimately target 10 to 20% per year. You shouldn't go for more than that. More than that requires a lot more risk, and more risk means that things can go badly. The realistic target will also help you determine how much risk you should take on your investments. Do not chase after losses. So from time to time, you're going to make a bad investment. That's okay. You take your loss and you move on. Your performance will be the function of many investments and many trades over a long period of time. So you should not get attached to any particular trade or investment. Stick with the plan. Catching a big trend may take months of waiting and positioning. If you stick with the plan, once the trend unfolds, you're going to catch profits on it. Also diversify as much as possible. As we've seen, waiting for a trend can last a long time, but if you fraction your risk across many markets, you might be catching a trend in gold market while elsewhere you're maybe just waiting or treading water. When that trend peters out, maybe there's going to be trends in cotton or gold. So the more diversified you are, the more likely it is that you'll be catching a strong trend in one of the markets that you trade. Finally, always cultivate steadfast discipline. I'll mention one last reason why you should consider trend following. And the reason is that trends eventually reverse and asset bubbles always burst. So what we're looking now is we are currently in an asset bubble, but what happens when asset bubbles burst could be very distressing. So what you see here is in 1980s, Japan had its big bull run that lasted the whole of the decade of 1980s. Something possibly similar to what we're experiencing in the United States now. But when that bubble burst, what you had is a bear market that saw an 82% decline in stock prices and a bear market that still hasn't recovered. So we are now more than 30 years after that bubble peaked, and stock prices in Japan have still not recovered to the peak value in December 1989. Something similar happened in the United States during the Great Depression. So we had an 86% decline once the 1920s bubble burst, and it took the S&P 500 29 years to reach full recovery. So if you use trend following, you can actually profit even in the bear market. Simply, once you see that the trend is down, you sail with that, you go short, and you profit from the decline in the market. Trend following will tell you when to get out. It will also tell you when to get back in. So it's worth your while to study trend following if you're managing your own investment portfolio. This is the end of this presentation. I want to thank you for your attention. And now we can, if there are questions, I'll be happy to answer in a conversational way, without any structured bullet points and stuff.
Well, thank you very much, Alex.
My pleasure. Thank you.
We had a Frankie and we had a Franco Lopez asking questions. So Frankie said, so to generate $100,000, you need 1 million. That's a 10% a year.
Well, yeah, okay. So I said that the legitimate investment performance target should be between 10 and 20%, right?
Okay.
What I said is that the very best hedge fund managers, and believe me, you're talking about people who are extraordinarily smart, who have almost unlimited resources, right? They have all the analytics the money can buy. They spend their whole day reading and analyzing. And basically, it's true that they'll have 30% years, they'll have 60% years. But if you look at their performance over long periods of time, like 5-10 years, it tends to top up at about 16%, which means that their gross performance before fees is around 20, low 20s. So if the best of the best, and believe me, they are incentivized, if they could sustainably make higher returns, they probably would. That would make them wealthier, that would make them more competitive. They definitely would, but the limit is those, let's call it 20% gross. So I think that if you want to earn greater returns, you have to take greater risks. And the problem with greater risks is that things could go wrong. And then instead of making 50% a year, maybe you lose half. And that's no good, because what you want to do is you want your investment portfolio to grow over your lifetime, not think about, I need $100,000 to be comfortable for a year. So that's what I want to earn, because the empirical data is staggering. But let's say that in 2016, the British market regulator, FSA, they published an 11-year study of retail investors, and they found that fully 82% of all retail investors lose money. And in some jurisdictions, the retail brokers have to disclose on their front page the percentage of their clients that lose money, and the figures are between 70% and 81%, right? So if you trade, the odds are really stacked against you. So you have to be very careful. And like a lot of these people, they read, they're motivated, they want to make the money. They're not trading because they want to lose the money. but nevertheless, 4 out of 5 do lose money. So you have to manage your risks very carefully. You have to set the right target, because if you set the wrong target, things go wrong. Usually errors compound errors. You try to make yourself up. You try to recover your losses. That usually leads people into greater risk taking. And from there, things can go wrong. Rather than thinking in terms of, I want to make $100,000 a year, you should think of this as your seedling, which will take many years to become a tree with deep roots, and tree that you can pick fruits without losing the substance in the future. So it's better to grow it gradually, to take less risk, and to compound your wealth for later date than to try to make too much money short term.
We have a very interesting question from Greg. Actually, no, it's actually Joe. So Joe. And well, first question is based on your Tesla analysis. Would you advise we buy Tesla shares now, or is it too late?
No, I think it's too late, but I could be wrong. I think it's too late. The reason why I think it's too late is that the whole stock market is in a bubble. So stocks are more expensive than they've ever been in history, like in terms of equity to GDP. The system is far too, how do you call it? The system is far too burdened with what do you call it? With debt. There's a risk that we are, that the bubble, like the higher the bubble goes, the closer we are to the point of bursting. And Tesla has had a phenomenal run 120 times in 10 years. I think it's not realistic to expect that it'll do the same as it has done in the last 10 years. So I would say a no on that. I could be wrong. You never know, but I think that ship has sailed.
Thank you. We have you can just briefly explain to Joe. Joe has a question. Can you please further explain why we should not day trade? Just briefly, because we have a few more questions. Why we should not day trade? Just brief explanation.
Very briefly, because it doesn't work. It simply doesn't work. Let's say if you have a very, very highly sophisticated strategy that you worked on, where you have a very well thought out, very thoroughly defined risk-taking profile, very strong discipline. I know day traders who are successful, but they have a large capital base, and they trade small bits that like they make 100, 200, $300 per trade, but their capital base is several million. 95% of day traders lose money. We're not, we're not hardwired for this, and so the odds against you are extremely unfavorable. So that's why you shouldn't do it.
Okay, thanks. So I know for a fact that Alex does not trade single stocks, but he does it by custom. If you're interested, in a custom reading, he does it by custom. But he's not a stock picker, because someone has a question here about which company do you think you should invest right now. But as a second question,
yeah, I couldn't give you.
Yeah, but yeah, he is not doing single stocks. But here's an interesting question from Frankie. What is the next big trends that you will be interested in? The next
precious metals
right now.
Precious metals. I believe gold and silver.
Long or short?
Long. It might take a while. Gold and silver are still vulnerable to flash crashes, to market manipulations, and so forth. But two things. Commodity prices in general are relative to equities at their lowest levels ever. That is, they're near their lowest levels ever still. There's something like $200 trillion in the shadow banking system, right? Shadow banking system is the hedge funds, private equity, endowments, pension funds, and so forth. So there's a massive amount of liquidity that's available to chase after assets. Commodities are at their lowest levels relative to equities that they've ever been. And within the commodities complex, gold and silver are at their lowest level they've ever been in the last, I think, 10 or 15 years. So gold and silver have really been unpopular in the markets for the last well, let's say until the last few months. Now they've recovered a little bit, but now they're under pressure again. But the thing is that when some asset becomes popular, like Bitcoin was this year, like Tesla has been, Apple, Microsoft, Tencent, Alibaba, and so forth. When some asset becomes very popular, then there's a huge pool of liquidity that suddenly panic buys it. This still hasn't happened for gold and silver, and I think that there's a legitimate reason, even without this consideration, why everybody should have some gold and silver in their portfolio. And so I think that at some point when fashions change and when investors decide that, oh, I want to be in gold and silver, that this massive pool of assets that's available to bid up the prices, when they start moving into gold and silver, we might see one of those hockey stick charts that we've been seeing more and more frequently now in not just Bitcoin. You've seen it now in natural gas, in coal, you've seen it in one market after another, oats futures, cotton. It just hits one market another. And I believe it's because there's, like with all this QE that we've had, with all this enormous monetary expansion that the Fed has done, the shadow banking system is awash in liquidity. They need to take increasing risks to generate returns. And so even if a small fraction of that pool of assets decides that they want to go into gold and silver, I think the risks are on the upside. And so I believe that that might be the next big trend. We don't know when that's going to happen. It could be months, but I think that that's probably the one story that hasn't yet happened and that is very likely to happen.
And we had a question from Alex. Let's see, where is it? Which trading software would you recommend? Which trading software? So is this like Alex? Is this for day trading? What is the question? Is this for day trading or that's Alex? Students, Alex.
For day trading, I couldn't recommend anything because I haven't done day trading since I've done it 20 years ago. I can confess it didn't go well. I published a trend following newsletter, which generates daily trend following buy and sell signals. I think that many of these retail brokers provide relatively good tools. The most popular trading platform apparently for quantitative trading strategy is MetaQuotes. There's also Ninja Traders. I don't honestly know which one is the best. I think that you'll maybe get better information if you just look at their message boards and forums, discussion forums, and the user recommendations. Like if it's about day trading, I can help. If it's about trend following, I can help.
Great. So Greg is making lots of good comments here about Tesla and about analysis, about correlations. I think you spoke about correlations and causation already in your presentation.
But it's one of those things. If we, unfortunately, if we could sit in the pub with a drink, we could probably speak about these things for the next 10 hours. I have, let's say that when I came out of university, I basically did fundamentals analysis. I began as an oil trader. I was in an oil company. I looked at the oil markets. I read everything I could get my hands on. And I kind of thought that fundamentals were the ones that drove the price. So I studied fundamentals. I studied correlations, all of these things. Unfortunately, it just simply didn't work. And then I discovered trends basically by just looking at what's happening. And I was watching in the, let's say, late 90s. We all thought that oil prices were going nowhere but up. So let's say 1997, oil was $20-some a barrel. Economic growth was going on all cylinders. The stock markets were booming. The demand was rising. And because capital was favoring technology and pharmaceuticals and so forth, the investment in oil research in refining, in extraction was severely curtailed. So we thought, okay, so demand's going up, supply is going down, oil prices have got to go much, much higher. And then from 1997 until 1999, oil prices more than half. So we went from $22, $23 a barrel to $9 a barrel, in spite of the fact that we all in the industry knew that oil prices had to go up. And then by the time we got to the $9 a barrel, people got so bearish that everybody was talking, no, it's going to $5. Literally, it was like the consensus that it was going lower and lower and lower. And then over the next, I don't know, year or two, oil went to $35 a barrel. Again, nobody saw it coming, but it did. So basically, that's what formed me as a trend follower, because I said, we keep getting it wrong. We read everything. We have like decades of experience in oil markets in this company. We read everything there is to read. We analyze everything. We speak to the brokers, to the bankers, to the traders. We know everything there is to know about this market, and we keep getting it wrong. But what's actually happening out there is that markets are moving in trends. First they went down, then they went up. So why don't we just forget all these complications and all these discussions and try to figure out what these trends are and how to catch them and how to capture the most value possible from trend moves when they happen, rather than trying to predict what's going to happen. So correlations are part of that story. All I can say about correlations is that this is the exact reason why in one of the do's and don'ts I say diversify as much as possible, because if you trade different markets that are not correlated, that's the only free lunch you have in investing. Basically, that for the same amount of risk, you get more returns, or you get the same returns for less risk if you're diversified between non-correlated markets. So you have some allocation to stocks and bonds, you have a little bit of allocation to, let's say, gold, silver, some allocations to energy. And I think that today you can do that. You don't have to trade futures. You can do that with ETF funds, for example.
Well, Alex, thank you very much. There are a few more questions, but some people have to go because they're on a lunch break and you're probably hitting your dinner already.
Yeah.
In Monaco. So thank you very much. That was very interesting presentation.
My pleasure. Thank you for having me. I hope this was interesting. If I haven't included my email in the presentation, the PowerPoint, but I'm very happy if you want to share my email with your students. And if there are questions, I'd be happy to try to get around to them. I do endeavor to answer a question if people ask. So, Damir, if you would share my email with your students, that would be a way for them to ask further questions if there are any left.
I will. So
right, excellent. Thank you very much.
Thank you, Alex, very much.